So welcome to Chapter 1 of your FA course, Financial Reporting and the Financial Statements. In this first part of this first video, I'm going to focus in on business entities. And in the second part, we'll deal with financial reporting and indeed statements. This first chapter is important for us just to get to feel for really the whole course. I mean, everything within this chapter is going to be referenced in various parts of the chapters and videos that we run through as we get towards the end. So let's take a look at this first area, and what we're going to focus in on here is really the idea that business entities come in a number of different forms. And let's say that you were deciding to set up a business, you would have several options. Let's look at the first area of sort of why businesses exist. I mean, obviously, for most businesses, indeed most businesses that will feature within this particular area or section of the course, there will be what's known as for profit. So businesses exist to make a profit. They may sell goods, they may sell services. Now, obviously, there are other types of businesses too, or entities, if you will. For example, not for profit. So think of something like a charity or an NGO, a non-governmental organization. But in the main, for our purposes here, we're focusing on businesses that exist to make a profit in some way, shape, or form. But businesses can be different in a number of different ways, and we'll see reference to the different, what you would call mediums. You know, for example, a sole trader, a partnership, or a limited company. So in terms of their sort of financing or size or legal position, they can certainly vary. So the main examples that we're going to see within this particular section are sole traders, partnerships, or limited liability companies. Now, we'll go into detail on these, and broadly speaking, if we go from the bottom to the top, I would suggest to you that sole traders are very simple, very straightforward, very easy to set up, and generally centered around one person. Partnerships involve several people, also quite straightforward. In essence, partnerships are really a sort of a set of sole traders. And then we would move on to limited liability companies, a little bit more complex, governed by Companies Act, more administration, more cost, etc. So, moving from there, let's drill down into sole traderships. Now, as just mentioned, this is really the simplest form of trade. I mean, any business can be set up as a sole tradership very, very easily, really in any tax jurisdiction, in any country. It would take probably no more than a day or two to really register a sole tradership business, to set up a bank account, etc. And then really you're ready to trade. And the key point here is that sole traders are one person. They trade in business alone. Either a person perhaps operating a shop, a person operating a consultancy service, etc., etc. So the sole traderships are about as straightforward as you can get. Now, in terms of the legal differences, now note that we're comparing sole traderships to partnerships and indeed limited liability companies in this particular video. Let's look firstly at the change in business ownership. So, for example, if you were operating a sole tradership and the business ownership were to change, how would you do that? The only way to do that is to sell on to perhaps a new owner, perhaps another sole trader, perhaps a limited company, perhaps a partnership. But in essence, the business is the person. If you want to change the ownership, you change the owner themselves. Moving from that, in terms of continuation, if we sell a business as a sole trader to another person, the existing business ceases and the new business commences. Note the difference between that, let's say, and a limited liability partnership, where ownership is based on a shareholding. So just because a shareholder will sell their shares doesn't mean that the business does not continue. It certainly does. Outside of that, we look at taxation. Now, sole traders are really taxed in their own right, individually, based on the profits of the business. And I mean, technically, the owner themselves isn't taxed, it's the business that's being taxed. Next area for us is the area of business property. If I operate as a sole trader, then really there is no separation between me and indeed the business property that the sole tradership owns. Absolutely none. Really, the business is the sole trader. The property is owned by the business. Therefore, the property is owned by the sole tradership itself. Moving from there, final key point here is legal action. And this is really key to the existence of a sole tradership business, because really the buck stops with the individual. So there is no separation between actions of the individual and indeed actions of the business. So for example, if there is a dispute, some sort of legal issue, the individual concerned, the sole trader, is liable for all the debts, penalties, fines, etc. in any way, shape or form. That creates a little bit of an issue for sole traderships and is completely unlike, let's say, again, a limited company, where there is a separation between the business and the actions of the business, for example, the directors, and indeed the ownership of the business, which would be the shareholders. Our next section really concerns advantages. So let's just say that you were to decide to set up a sole tradership. What would be the main advantages to you of doing so? Well, we've touched on a few of them already. The first thing is really quite important. I think it's control. One of the issues of being in business, certainly in my experience, is the involvement of other people. If you're running a business as a sole trader, then you decide on every course of action. You decide on what products you sell, services you offer, and indeed, at the end of the day, your advantage is that you take the profits. In other words, you do not have to split the profits. So sole traderships have complete control over what they do and indeed the success of the business. Outside of that, formalities, as mentioned up top, it's very, very straightforward to set up a sole tradership business. It's very, very straightforward to operate it. Within a day or two, you can be operating in business. There's no Companies Act, there's no companies legislation. You don't even have to publish your accounts, unlike, let's say, a limited liability company. So very, very simple. Final key point is really flexibility, and indeed, you can work as many hours as you want. You can work as few hours as you want. You're not beholden to any particular, let's say, partnership agreement or shareholder agreement, etc. Really, sole traderships offer complete and indeed wide flexibility in every way. Now, the flip side, again, we've touched on these points up top. The flip side really is the buck stops with the sole trader. An individual sole trader is fully liable for all the business debts. So if a sole trader makes a poor decision, a wrong decision, then the liability rests with that individual. And indeed, in saying that, that individual's personal possessions are up for grabs to allow for any business decision or any incorrect business decision that the individual has made. That could be their home, car, etc., etc. So liability is a key issue. Second area is finance. Now, according to the portal in this particular section, it says that may not be able to raise finance. That's true. It's more difficult. It depends on the assets available to the sole trader. So for example, if the sole trader can provide security for a loan, let's say a bank loan, then they will be able to raise assets. But I would agree that it's a little bit more difficult for individuals to raise finance than, say, a limited liability or a set of individuals, i.e. a partnership. Third and final point is sort of a continuity. Really, the business rests with the sole trader. If they cannot work, if they die, if they retire, then in essence, the business ceases. That's unlike, as we said up top, a limited liability company or even a partnership that has a number of partnerships. The business will continue, let's say, if one partner leaves, or perhaps with a limited company, if a shareholder passes away, the business will still continue. So that's an issue for this sole tradership medium. Now, partnerships, as I mentioned up top, in one sense, partnerships are really a set of sole traders, but they are bound by what you would refer to as a partnership agreement. So in essence, we're talking about two or more people owning and indeed running a business together to make profits. As mentioned, generally speaking, a partnership agreement would underpin the arrangements between those two or more people. And a partnership agreement is essentially just a contract which sets out the terms on which the partnership would operate. Now, in terms of legal differences, several here. The first thing is the change in business ownership. The partnership agreement will sort of lay out the parameters where partnerships are either joining or indeed leaving. Generally speaking, when you have a partner entering a partnership, they will enter through some form of investment. So, the business ownership can change every year. It could change every 6 months. We could have partnership leaving or indeed coming in. Next area for us is continuity. Certainly, partnerships change from time to time. Think of an accountancy partnership. It could have 5, 10, 50 partners. And in essence, if a partnership leaves, then a new agreement would need to allow for the remaining partners or indeed a new incoming partner to continue the partnership. Next area is taxation. As mentioned up top, generally speaking, partnerships are taxed on the profits, but what you'll find invariably in most jurisdictions is those partnership profits are directed through to each individual. In other words, at the end of the day, yes, the partnership is taxed, but the partnership taxation is split on a sort of a sole tradership basis. So you'll find that individual partners are taxed in a very, very similar way to sole traders. Okay. Next area for us is ownership of business property. Again, very much like sole traders, there's no separation. The business owns a property, and indeed there's no separation between the ownership of that property and indeed the partners themselves. They will have a split share. Last area for us is really legal action, and there's a key phrase here: joint and several liability. So what that means, although it's not referenced on screen, is that the partners are certainly legally liable for the actions of the partnership. And when I say joint and several, let's just say that if a partner is unwell or a partner dies, at the end of the day, each of the partners are fully liable for the actions of all partners. That's what joint and several means. So in one sense, one should be very, very careful about choosing partners to go into business with, because if other partners make poor decisions, the remaining partners are liable for those decisions. There's no separation in any way just because another partner did the action. Okay? Now let's look at the area of advantages. I mean, obviously operating in business with other people can bring in new skills, new expertise, etc. Over and above that, in terms of defined roles, it may well be that each partner brings in a different level of expertise in some way. So really having more than one person, a la a sole trader, can give you advantages. Okay. Outside of that, In terms of the finance, certainly having more than one person gives the opportunity to put assets down or securities or guarantees. So it may well be, and it invariably is, that raising finance for a partnership is a little bit easier, particularly where you have a new partner coming in, because invariably new partners will be required to bring in new investment. Last area for us is really paperwork. Certainly, like sole traders, partnerships do not have to file accounts publicly. You can't search, let's say, on Google or at Companies House for financial statements relating to partnerships, but certainly they are required to keep proper accounting records and indeed to file accounts and returns annually, like a sole trader would, with various tax jurisdictions depending upon the country. So probably a little bit more paperwork, but certainly not as much as we'll see with limited companies. Disadvantages, certainly working with other people can be a disadvantage, but I think the first key point is the idea that at the outset, let's say unlike a sole trader, you will require a bulletproof and indeed comprehensive partnership agreement that sets out how the partnership will run. Now, it says that this will cost money and it may be expensive, not overly expensive. You could probably draw up a partnership agreement, a fairly standard agreement, for €500 or thereabouts. It depends on the number of partners, but there is a little bit more administration and costs associated, let's say, with running a partnership as opposed to running a sole tradership. In terms of decision making, obviously where there are more than one person involved, the time taken to make decisions will slow down. So that to some extent can affect the progression or indeed the development of the business. But as we said, on the flip side, maybe 2 heads or 5 heads are better than one. Last area for us is really profit sharing. Unlike with sole traders, where the buck stops with the sole trader, if the business is a sole tradership and it's very, very successful, the profits are geared towards one person. In this particular case, obviously, profits are being shared and indeed losses are being shared. So that creates a little bit of an issue, particularly if you have differing levels of input or perhaps expertise or experience between different partners. Next area for us is limited liability companies. Now, this is the big one. Limited liability companies come in a number of different forms. And broadly speaking, private versus sort of public or listed. So by private, we mean that the shares are owned privately, perhaps by a few people. By listed or public, we mean that they're being traded, let's say, on a listed stock exchange. So in essence, if you wanted to set up a limited company to run a business, you would incorporate it, you would issue shares, let's say, to several people, and those shareholders would then be the owner. A couple of other points. The essence, generally speaking, and you remember at the outset, we talked about businesses being for profit making. In other words, seeking profit. Now, certainly sole traders and indeed partnerships invariably seek profit, but the key point really with limited liability companies is that the essence is shareholder wealth maximization. Now, what do we mean by that? Well, we've just said that if we're operating through a limited liability company, then we would incorporate and we would issue shares to shareholders. Now, that doesn't necessarily mean that the shareholders involved in the management of the business. In other words, they may not be directors. So the key essence of limited liability companies is that whoever is guiding or directing or managing the company should focus on shareholder wealth maximization. Now, what does that mean? Well, that really means 2 things. The first thing is for shareholders will want a return, i.e. some form of dividend or distribution, preferably on an annual basis. In addition to that, given the fact that they own an asset,
i.e. a share in the business, they will hope that, let's say from the beginning of the year to the end of the year, based on the company's success, that the value or the capital value of that share increases. So really there's two forms of shareholder wealth maximization: a return, let's say periodically, and indeed capital growth in the share. And everyone who is tasked with directing or managing or running a limited liability company should be focused on shareholder wealth maximization. Now, as just mentioned, more often than not, you will have directors who are hired to run the company. Now, it may well be that shareholders are also involved as directors. You could have two roles. You could be a shareholder and be a director, but for our purposes, generally speaking, we separate ownership, i.e. shareholders, from control, i.e. directors and managers. So directors are running these companies, and indeed shareholders, let's presume, are really just liable for their investment. In other words, they're not responsible necessarily for all the actions of directors. Final key point here is that, as just mentioned, the public versus private. Now, you're probably familiar, perhaps you own shares in a listed company, and you'll be familiar with the sort of plethora of regulation surrounding public limited companies. If a company is going to list, then it's really guided by not just Companies Act, but stock exchange regulations, corporate governance, etc., etc., etc. So there's a lot of red tape. For private companies, certainly the Companies Act is in play, but much less red tape. I mean, you and me could set up a private limited company within 24 hours. It would probably cost €100 or thereabouts, and we could be good to go as long as we have issued shares, set up a bank account, registered with the tax authorities, etc. It's quite straightforward. As you get into the public company sphere, things become a little bit more complicated. Outside of that, in terms of legal differences, certainly quite a few here. Let's talk firstly about change of business ownership. Now, this is actually fairly straightforward, because if you imagine, if you own a share in a business, you can sell it, or perhaps you can buy shares, and there's no requirement for necessarily for other shareholders to agree in any way on an incoming new shareholder. So fairly straightforward in terms of the change in business ownership. Excuse me. What about continuity? Well, really, the company's existence is in its own right. A company exists because it has owners in the form of shareholders. So just because shareholders change does not mean that the business ceases. It does not affect the business's existence. Next key point is taxation. Again, taxation based on profits. Note that the shareholders are completely separate here. The individual shareholders will be taxed on their own income. For example, they may be employed somewhere. They may have dividends from this limited company. But at the end of the day, the profits of the business, the profits of the limited liability company are taxed to corporation tax at the relevant rate in the relevant jurisdiction. Next key point for us is ownership. Now again, we know that this business, this limited liability company, exists in its own right. A limited liability company, unlike a partnership, unlike a sole trader, exists on its own, and indeed it can own property itself. The ownership isn't in a given person's name or an individual shareholder, and indeed individual shareholders and directors do not have control over that property. They do not own it because the business owns it. The limited liability company stands in its own right as the owner. Next and final point is legal action. Now this is important, particularly if you're planning to get into business down the line, and perhaps you're in a a sensitive area. The legal repercussions for actions in relation to the company are for the business only. Shareholders, for example, and to some extent directors and managers are a separate side. So as long as individuals who are connected with the business, i.e. directors or shareholders, as long as they have not overstepped the mark in a legal sense, then if a company, a limited liability company, is to be sued, then it will be sued in its own right. You can't bring in liability, for example, for a shareholder or for a director, unless they have been shown to do something wrong. So there's a separation of ownership and indeed liability entirely. Next point for us is really advantages. Now, as we saw above with sole traders and indeed with partnerships, there's pluses and minuses to operating a business as a sole trader, partnership, limited liability company. My view is, broadly speaking, and I'm speaking from a practical perspective rather than an exam perspective, it depends on the circumstances. It depends on the industry, it depends on revenues, profits, etc. It depends on a variety of different factors. I mean, let's focus in on, let's say, a limited company. What would be the things that would draw you to operating, let's say if you were to set up a business as a limited company or liability company from the off? Well, the first one is a big one, is really protection, liability. This idea of limited liability is just that. It limits liabilities for directors and shareholders from actions. So if something goes wrong, as long as those directors and those shareholders have not overstepped the mark, let's say, for example, wrongful trading or fraudulent trading. Let's say a director defrauds a customer. Now, liability will be directed at that director. There's no limited liability there for the director. Certainly for shareholders, generally speaking, because they're not involved in the day-to-day running. They're waiting for their dividend, they're hoping for capital growth. Generally speaking, shareholders are protected, and protected to the extent of their investment in the business. What does that mean? Well, let's just say that there is a situation in relation to the fraud of a director and the company gets shut down. A limited liability company will protect a shareholder to the tune of that shareholder's investment. So if I'm the shareholder, if I've invested 1,000 euros, then that's as much as I can lose. I can't be sued for anything other than that. I will just lose my shareholding. My 1,000 euros is gone. So liability is a key issue. The second point is raising finance, and it suggests here easier access. Generally speaking, yes, because investors, venture capitalists, angel investors, banks, more often than not, like the protection of operating or working with companies that are established, limited liability companies. So it may well be that the range of finance available opens up more than, let's say, with a sole trader. Okay? In addition to that, we know that companies, in the second sentence here, can issue shares. So we may be operating for 5 or 10 years. We may decide to that we need $1 million worth of finance. We could issue new shares to new shareholders. So a simple way to involve new shareholders, or indeed to go the public route, where we list shares available to the public. So raising finance, certainly a key issue there in terms of an upside or an advantage. In terms of continuity, certainly a limited liability company can be transferred, because all you would need to do is arrange for, let's say, all or a majority of shareholders to sell their shareholdings to another shareholder. So in essence, the business ownership changes through simply the change in ownership of shares. Next area for us is flip sides or disadvantages. Now, certainly, as with up top, there are. First things first, setting up a limited liability company. I wouldn't say it's complicated, but certainly it can be costly. You're probably talking about several €100 or thereabouts, and it may well be over and above that an investment is required. Over and above that, I would say outside of the setup costs, i.e. incorporating a company, the ongoing costs will probably be reasonably considerable because there is more administration associated with complying with Companies Act and complying generally with other regulations than, let's say, a partnership or indeed a sole trader. In addition to that, one will find that producing annual accounts, producing annual tax returns for limited liability companies will cost more in terms of professional fees. I'm talking about accountants, tax advisors, etc. So costs is a fairly significant limiting point. In terms of taxation is actually fairly straightforward for limited liability companies. They are taxed to corporation tax on their profits. Let's note here that the owners, again, I mentioned this up top, i.e. the shareholders, and indeed the directors, are taxed individually. So, for example, a shareholder may be taxed on dividend distributions, directors will have salaries, etc., etc. So there's a complete separation for tax purposes to the profits of the limited liability company. Final area for us is, the public eye. Certainly, this will vary from limited liability company to limited liability company, but certainly the public eye is relevant here because companies need to file accounts. They need to file accounts, whether or not they're private or indeed publicly listed. So, strictly speaking, if a company is operating, they will file accounts every year, and you will be able to have access to those accounts. Any individual could simply search on the Companies House database to get access not just to accounts, but to other information. For example, who are the directors? What are their residential addresses? Etc., etc. So, in essence, some exposure to the public, and then over and above that, note that companies, strictly speaking, particularly listed companies, need to have AGMs or general meetings. So there is that exposure to other stakeholders, people finding out about the business, people being able to find out about the business very, very easily. So certainly that would be a consideration. So let's move into the next section here, financial reporting. Let's sum up so far and just establish what we've gone through. We've taken it fairly easily, fairly slowly. We've basically said there's three main mediums. There's three ways in which, let's say, you or I can run a business: sole traderships, partnerships, and indeed limited liability companies. For the purpose of the exam, we need to know the little nuances, the little differences between each of those. And believe it or not, we will get questions that set up, let's say, information relevant to a sole tradership versus information relevant to a limited liability company. So getting a feel for the key differences. You don't need to be an expert, don't worry about it. You don't need to be some sort of legal guru, but certainly get a feel as we run through part by part on the main areas. And let's just practice questions to get better and better. So financial reporting, what does this mean? Well, we've talked about different forms of business. Certainly different forms of business need to report. In particular, limited liability companies, what do they report? Well, they need to report their results. Financial reporting is about recording, analyzing, and summarizing financial data to present the performance of the business or the results of the business. Now, certainly think about a limited liability company. Financial reporting is crucial, really, because you've got shareholders who've invested in the business, and you may well have directors or managers who are running the business. Shareholders need to know that transactions are accurately recorded and analyzed and indeed summarized, and they need to know that when directors file accounts annually, that information is accurate. So what are the other key issues in terms of financial reporting? Well, first things first, recording. And you may well work in accounting, you may not, but certainly what we mean by recording is that every business, whether or not they're a sole tradership, partnership, or limited liability company, will have a myriad of different transactions, sales, purchases, petty cash, bank transactions. These need to be recorded accurately, and then over and above that, they need to be analyzed properly. In other words, they need to be set into various parts of the accounting system. If you record an expense, we need to ensure that it's expensed into the right expense account. Motor expenses, not stationary. Outside of that, and these areas of accounting, management accounting, will obviously happen daily, weekly, monthly. Information needs to be summarized. In other words, we need to know, looking back over the last month or quarter, what have we spent on motor expenses? What are the sales? What costs have we incurred in terms of equipment purchases? So really we go from these first 3 areas to record, to analyze correctly, and indeed to summarize into our financial statements. In other words, our reports. And we'll see as we move forward in this particular mind map that there are a series of key financial statements, namely the statement of financial position, statement of profit and loss account. But everything is driven really from proper recording, proper analyzing, and proper summarizing. Without those, our financial statements will not be overly usable. Next area for us is really a focus in on, bear with me one second, a focus in on the sort of principles. In other words, when we think about financial statements, we need to gear them to some set of rules, principles, if you will, because that will aid users and also aid comparability. So in terms of a key definition, when I mentioned statement of financial position, when I mentioned statement of profit and loss account, etc., what do we mean? Well, basically information regarding results. Every business, let's say, is pursuing shareholder wealth maximization and profits. So at the end of the day, whether or not you're a sole trader or a partnership, we need to have a fix on the results for the past year, quarter, month, etc. Now, outside of results, obviously, as businesses develop, whether they're sole traders, partnerships, or limited company, they will acquire assets and indeed liabilities. In other words, they will acquire, for example, equipment, buildings, etc., etc. They will also acquire, most likely, liabilities. They will borrow bank loans, trade creditors, hire purchase agreements. So in essence, what financial statements at this early stage of our work, what we need to be clear on is, very simply, we're interested in results, and we're interested in what the business owns and indeed owes. Let's look at the main ones. Now, I've touched on them already. First one really is the statement of financial position. Now, that sort of does what it says in the tin, because in essence what we're saying is, as at a given point in time, any business, let's call it a limited liability company, will have some form of financial position. And what we mean by that is, what does it own and what does it owe? And I've just listed a few examples there taken directly from the ACCA hub. It may own landed buildings, equipment, perhaps some goods not yet sold, i.e. stock or inventory. It could have some cash in a bank account. It could be owed money by customers, i.e. accounts receivable. It could owe money to suppliers, accounts payable. It may owe money to the tax authorities. So really, the statement of financial position is important because it tells us that this particular business owns this and owes this. Think about it from a personal perspective. You, at this moment in time, will own some things and you will owe some things. So that statement of financial position, perhaps for you individually, would be simply a list of what you own versus a list of what you owe. And the difference, note, is what's referred to as net assets. That's your net worth. And it's the same for a business, because the statement of financial position will show the difference between assets and indeed liabilities. That's quite important, because ideally businesses want their assets to be well in excess of their liabilities. If it's the reverse, that's known as insolvency. That's known as bad news. So that's the statement of financial position. Now again, let's try and pick up as much as we can. We don't need to remember everything. Let's just get a feel for financial reporting. So next one, statement of profit and loss or other comprehensive income. So this does what it says in the tin. We're looking at how has the business done in trading over the course of the last period, generally a year. So I'm looking, let's say, at a statement of profit and loss. I can see revenue, let's say costs of trading, perhaps other running costs of the business, perhaps costs of finance, and indeed income taxes on the profits. So really, this statement of profit and loss or other comprehensive income is a list of how the business has performed in the last period. Revenues, broadly, less expenses equals profit or possibly loss. So again, an important statement. Remember, we've referred up top to results. This is where the results come in. The next area for us is cash flows. Now again, this is an important area, and you'll see this referenced in other areas of your ACCA subjects and indeed your qualification. You know, cash is important to businesses, and cash is the lifeblood of business. In fact, you may be familiar with the old adage or phrase that in business, cash is king. Without cash, you can't do anything. So let's refer back to this statement, and then I'll touch a little bit more on the ramifications of cash and the importance of it. What does this statement do? Well, it simply says that in the course of the last year, we have had these receipts of cash, these income in some way, shape or form, let's say from customers or possibly from other areas, and we've had issues of cash or indeed payments, let's say, to suppliers. We purchased non-current assets, we paid tax authorities, we returned borrowings, etc., etc. So really, the statement of cash flows is a comprehensive look on exactly how the business has received cash in and expended cash out, to who and how. Okay, so again, an important document and an important statement. As mentioned, the cash of the business is very important, particularly for users or for stakeholders, because people need to know, where does this business spend its cash? And indeed, certainly in my experience of working in public practice, so working for clients, one of the biggest problems that I saw with different businesses was invariably cash management. In other words, managing their cash and being able to meet their short-term obligations. I mean, that's a major problem. Poor cash management leads to unsuccessful business, in my experience. The next area for us is the statement of changes in equity. Now, at this early stage of our studies, I think understanding everything about financial reporting and indeed, let's say, the statement of change in equity is a little bit tricky. But for the moment, let's just say that there is a statement that provides additional information over and above the three financial statements that we've discussed already. Well, remember, statement of financial position, assets and liabilities. Statement of profit and loss account, sales less expenses equals profit. Statement of cash flows, well, how has cash come in? And indeed, what have you done with it? How has cash gone out? This statement is really concerning the bottom part of the balance sheet or the statement of financial position, which is the equity section. And this concerns movements in equity, or what you might call sort of movements in reserve accounts. Now again, at this stage of our studies, we may not fully understand the reserve or equity section of the statement of financial position, but take it as read right just now that we're simply talking about movements in a particular part of the statement of financial position, whether or not that's movements from, let's say, proceeds of shares or dividends paid or perhaps profit or loss. The next area for us is quite important, non-financial reports. Now, this area has become more and more important in the last 10 to 20 years. So what do I mean? Well, when we say non-financial, we mean just that. We mean that really financial statements and indeed financial reporting has moved from what it was, say, 20, 30, 40 years ago, where it was very much geared to providing the numbers. What is your profit? What is your revenue? What is your sales? What assets do you own? And really, broadly over time, it's become relevant to provide users, stakeholders, other users of the account with more information. In other words, more non-financial information. Because obviously, some individuals are not financially savvy. They may be non-financial people. They may be experts in marketing, experts in sales, experts in production. And it may not be easy for them to read and to understand and to digest a simple set of accounts, as it would be, let's say, for an accountant or possibly a tax advisor. So really, non-financial reports come in a range of different guises, as you'll see. It could be the chairman's statement, perhaps it could be, an environmental report. It might be sort of reports relating to our employees, how we've trained them, new facilities for them, etc., etc. But this fifth area here has certainly become more relevant in the last 10 to 20 years, as I've said, and it's sometimes referred to, if we bring in the area of integrated reporting, is sometimes referred to as sort of narrative reporting as opposed to financial. In other words, rather than reporting through numbers, report through words. So this fifth area is important, and you'll see reference to it in other subjects in your ACCA qualification too. Okay? Moving on from there, in terms of detail now we've touched on the idea that one key report, in fact the first one that we touched on, the first one that we mentioned, was the statement of financial position. Now all I need you to remember right just now is that this statement concerns assets versus liabilities, or if you will, it concerns really providing information about what the business owns, assets, versus what it owes. Now, in terms of the format here, you'll see we have a heading at the top, GLARA's statement of financial position. I've just cut this out, obviously, of the portal. And the top area is non-current assets and current assets, and then a total for assets, i.e. total assets. Now, dealing first with the top area itself, non-current assets. What do we mean by that? Well, we mean assets, believe it or not, that are non-current. In other words, put simply, we mean assets that we expect to use in the business for 12 months plus. And that may be things like, as you can see, property, equipment, or motor vehicles. We're not talking about something that we're going to use for the next week and get rid of. Absolutely not. So we're talking about assets that are in essence fixed, broadly tangible, although you can have intangible assets as well. Okay? When you look at a statement of financial position, more often than not, this area of non-current liabilities may well house some of the biggest numbers that you see. In other words, the biggest assets that a business owns. Okay? Moving down the page to current assets. What do we mean by that? Now again, these are assets that we would expect to be using within the next 12 months. In other words, less than 12 months. And you'll see reference to inventory, trade receivables, prepayments, and cash at bank. So these are areas that we tend to flush through fairly regularly. Certainly we don't expect trade receivables to take 11 or 10 months to pay us? Probably 30 days, probably 60 days. In the same way, we don't expect our cash at bank and in hand to be exactly the same balance for the next 10 or 12 months. Absolutely not. It's, a working arrangement. We use cash on a regular basis. So the key point, and indeed the difference between current assets and non-current assets, is really the speed at which they're used and really the speed at which they create economic benefit. Okay? So you'll see that we have a figure for total assets. That is what the business owns, as referenced up top. Now, if we move down the page here, you'll see that this particular statement of financial position is reference to Gloria up top. Now, Gloria obviously is an individual, okay? She is trading as a sole trader. So within this particular statement of financial position, it's geared towards a sole trader. And that means that it will have this section in it called capital. Now, what does that mean? Well, capital means really what is owed or owing to the owner, i.e. Gloria. So we see capital brought forward. This is money that she will have injected previously. We add in profit for the year. We see that she's introduced, let's say, more capital introduced. And we have a figure for drawings, i.e. what she has drawn out of the business. That leads us to a total capital figure for the year. That amount, that total capital, strictly speaking, is owing to Gloria. If we move down the page, similar to what we saw up top in terms of assets, we see that we have non-current liabilities and indeed current liabilities. Same deal with the non-current liabilities. We're talking about liabilities that in effect are due in more than 12 months. And with current liabilities, less than 12 months. So certainly with Gloria, her trade payables, i.e. suppliers, let's say, that she owes money to, will expect to be paid in 30 days, 60 days. In addition to that, the overdraft, generally speaking, overdrafts are for the short term. So what we'll see in this second part of the statement of financial position is certainly, yes, the liabilities, but also the amounts owing to the owner, i.e. the capital. And you'll see that total assets highlighted there in the X, and indeed total capital and liabilities highlighted down the bottom will equal each other. And that is why this particular statement is previously and invariably called a balance sheet. Because as a result of double entry, and indeed double entry relating to all the business's transactions, at the end of the day, assets will equal liabilities and indeed capital. Okay? So there's a quick introduction to the statement of financial position. Again, remember what I said. We don't need to remember everything, but we do need to get a fix on this in the coming weeks. And the way that we're going to do that, obviously, is not least your run-through of the chapter itself and watching these videos, but remember that in terms of learning, your question practice is absolutely key. So I'm going to refer you to the question OT section of the course. Let's move on to the next section here. So this is the profit and loss account. Now you recall that in terms of the profit and loss account, all that we said was, well, the profit and loss account is linked to results. It's linked to looking at the difference, I guess, between sales and expenses, and that should hopefully elicit a profit. So I'll start with the P&L just here and run you down from the top. So what you'll see up top there is, in essence, sales, cost of goods sold, and gross profit. So what do we mean by those things? Well, in essence, we're familiar with what sales are. We have a business, let's say, that's selling products or indeed services. And indeed, there will be a cost associated with making that good or service. That's the cost of goods sold. The difference between those two things will be the gross profit for the business. Notice that I said gross, not net, because certainly as we see down below, we have a variety of other expenses that are not directly associated with the making of that product or indeed service. So gross profit is, I guess, the first profit figure that we'll see on a statement of profit and loss account, and it simply pertains to the difference between our total sales and indeed the costs of making those sales. If we move down the page, we see reference to other income just below gross profit. Certainly businesses, Glara's business and indeed other businesses will have other forms of income. What would they be? Well, they could be rental income. They could be interest income on cash reserves. So any business doesn't simply have sales income. It could have a variety of different types. Moving down the page even further, we see reference to expenses. Now, every business is different, but certainly as we said up top, recording expenses accurately is important within an accounting system. In order for us to be able to use a statement of profit and loss account correctly, we need to know accurately what we incurred on electricity, rental, repairs, etc. And more than likely, we need to compare that to last year. Is there a difference? Why is there a difference, etc.? So really, this second part of the profit and loss account lays out what you might refer to as indirect expenses, expenses that aren't directly associated with the cost of the product or the service. Those costs will be direct expenses. We move then down into our net profit and indeed other areas of income, i.e. other comprehensive income. And this area, not overly important to us right now. Really, we're talking about sort of what you might call sort of special forms of income. For example, property revaluation, etc. And right down the bottom, we get total comprehensive income for the year. So how have we got there? Well, we've simply taken our sales or our revenues, taken off our cost of goods sold to get our gross profit, added in any other relevant income, taken off expenses, got to net profit, and then added in what you might refer to as sort of special types of income, e.g. property valuations, etc. Okay? So, summary so far, we've been through statement of financial position, assets, fee, liabilities. Statement of profit and loss account, broadly speaking, sales less expenses. What do we have left? Well, we're going to move into the statement of cash flow. Now, the statement of cash flow, as I said, is really looking at, well, how does the business generate cash and how does it use it? Now, this is important, and, some observers might think, well, cash is not as important as profit. Well, other observers would disagree. And I think that's the reason or the origins for the statement of cash flows. Because if you go back to the mid-80s, the statement of cash flow wasn't required for businesses, not at all. It was simply within a set of financial statements. It was statement of financial position and statement of profit and loss account. But the relevance of cash has become more and more because people have begun to understand that, yes, you can have a profitable business, but if your cash flow is poor, that business could die. It could cease. You have to manage cash flow, and that really is the sort of reasons or the underlying reason, I think, why statements of cash flows have come into financial reporting, because cash is key. Cash is king. So what do we have within a statement of cash flow? Now, again, at this stage of our studies, we're just trying to pick up the basics. You'll see a variety of different sections here. Let's start at the top. We have our heading for Kenrabi Co. And we have cash flows from operating activities. Okay? Now, what we mean by that and what we're trying to get to there is cash flows that only pertain to trading. Okay? In other words, the trade of this business. As we'll see as we move down below, a business may generate cash in other ways. For example, they could sell an asset, or perhaps they could raise cash through share capital, or et cetera, et cetera. So all we're interested in this first part of the statement of cash flow is exactly how much cash has been generated from just our trading, our selling of our widgets, our product, our service, etc. In terms of the next section, the cash flows from investing activities, and do note that the operations and indeed the methods to produce a statement of cash flow will be discussed in the chapter later on in the course. For our purposes, we're just trying to get a feel. So, cash flows from investing activities, again, it does what it says in the tin. When we invest, we're talking about things like investment in assets. We may purchase an asset, we may purchase a car, purchase a piece of equipment. We may, in fact, sell a piece of equipment. So again, what we're interested there is things like property, plant, and equipment, but also perhaps interest and indeed dividends received. So those are areas where we are investing, not operating or trading. So again, when we take net cash used in investing activities, we're looking for that figure to add it into net cash generated from operating activities above. Next area is financing activities. What does that mean? Well, how do we finance ourselves? Well, perhaps we borrow money. Perhaps we repay loans. Perhaps we take loans. Perhaps we pay out dividends. So again, this idea of financing, it's the third sort of, key activity that a business would be involved in. And we need to pinpoint exactly how much cash has been used, or indeed perhaps even generated, from financing activities, because users of accounts want this information. Okay? As we move down, or slightly down the page, we'll see we get to the end of the period, and indeed we do what's known as, broadly speaking, a sort of reconciliation. A reconciliation between, as you'll see, the final two lines. Okay, this is the cash we had at the beginning, and this is the cash that we had at the end. So in summary then, with this third statement, again, an important statement for us, an important statement for your exam, certainly learning how to produce one. It's not complicated, don't worry about that. But also an important statement for users of accounts. We need information about cash, absolutely. Assets and liabilities, yes. Profit and loss, yes. But cash, how have we used it? Where's it gone? Our next area is this statement of equity. And you'll see, or you'll recall even, that I mentioned up top that this is linked into the statement of financial position. And what I mean by that is that the statement of equity, you'll see the columns along the top: share capital, share premium, revaluation, retained earnings. Each of those four accounts will be shown within the statement of financial position and will have a balance. So if you look right down at the bottom of the page, you'll see balance at 31st December 2x6. So those X's, those are the balance that we'll see in the statement of financial position. But those balances are made up of a series of different movements. So in essence, what the statement of changes in equity does for the user, and indeed for us, is it shows how these accounts, capital, premium, revaluation, retained earnings, how they've changed and what's caused them to change throughout the course of the year. So this is quite useful. I mean, let's think about it. I would certainly like to know with a business what dividends they've paid out, because I may be interested in becoming a shareholder. I also may want to know perhaps how much they've issued in terms of shares. Have they issued new shares in the year, and indeed at what price, etc., etc. So again, at this stage of our studies, let's just get a fix on the fact that the statement of changes in equity relates to reserve accounts on the face of the statement of financial position. Okay? Now, this next area for us is, I guess, maybe a little bit more manageable, not as technically complex as the first two sections, and certainly the second section where you had to sort of focus in on the different financial statements. Here we're talking about users. Now, we've touched on them already. We know they're important, and we know that users need accurate information. So let's touch on some detail here. First things first, stakeholders. Okay, invariably we could class users as stakeholders. What do we mean by that? Well, anyone who can affect the business or is affected by the business. Now that is a myriad of people: employees, customers, suppliers, directors, shareholders, etc., etc., etc. And note, they could be external to the business for certain, government bodies, lobby groups. So really, stakeholders are important, and indeed, they will all, note, have needs and wants. In other words, each stakeholder is different. So, for example, an employee versus a government. Governments are interested in tax compliance, companies filing on time, paying on time. Employees may be just simply interested in getting their wage at the end of each month. Directors may be interested in their bonus or perhaps a share option scheme, etc., etc. So all stakeholders are different, and indeed one of the go-to models that you'll see in your studies going forward in relation to stakeholders is a model called Mendelow's matrix, which basically prioritizes stakeholders for a given business and really provides advice on how to manage the more priority stakeholders and how to manage perhaps those that are less priority. So let's look at sort of categorizations next. Internal stakeholders. You'll see on the left-hand side we reference investors or owners. You might call them shareholders. We also reference management and then employees. And you'll see, as I mentioned up top, that each of these stakeholders have different needs, different information needs. So, for example, if we think about investors, what is their need? Well, they're concerned mainly with risk and return. They need information that allows them to make decisions. This company's doing really well. Maybe I should buy some more shares. Or the most recent financial statements were pretty poor. I think I should sell these shares. So in essence, what investors or owners, and indeed their advisors, are looking to do is to assess the performance of a given business from a risk and return perspective. They need to make decisions. What about management? Well, management, it suggests here on the left-hand side, they're more interested in management accounts than published financial information. I would say yes. What's the difference? Well, management accounts are really internal. Management accounts are produced very regularly, perhaps weekly, perhaps monthly, perhaps quarterly. So management are certainly concerned with planning, as we see on the right-hand side, decision-making and control. Their information needs are many and varied. And the bottom line is that, those management decisions on that periodic basis affect results. They'll affect the published financial statements. Next area, employees. Well, as I touched on earlier on, every employee is different, but certainly, stability is important. They want to know that they have secure employment, and indeed that their wages and their remuneration is going to be paid. Over and above that, they may well be looking to the future in terms of what is their package, what's available, retirement benefits or other employment opportunities, succession in the business, running up the ladder. So again, employees, different needs, different to investors, different to management. Now note that these three external are just some examples. We could perhaps include in there, let's say, directors as an example, who might have a slightly different viewpoint. So that's internal stakeholders. Let's move on to the next area, external. Now, again, there's a myriad of external stakeholders. This is just a synopsis or a few of them. So you see left-hand side, prospective investors, I would say similar to existing shareholders or owners in terms of their needs and want. Perhaps financial institutions, suppliers, customers, and indeed governments. So again, we'll see on the right-hand side that all of these stakeholders have a different need, or sometimes referred to as a want. Okay, remember reference to Mendelow's matrix, that tool or technique that I touched on up top. Very, very useful. So running down the page here, I mean, because we've dealt with owners, let's look at financial institutions. What would they be interested in? Well, note that financial institutions, certainly if you look at public listed companies in the UK, I think that financial institutions make up some 30 to 40% of ownership of listed companies. So when we say public, yes, we mean public, but institutions invest in businesses. So certainly these institutions, may invest in the form of loans, but they could also invest in the form of shareholdings. So their decisions are really based on, again, risk, I would have thought. In terms of suppliers, certainly suppliers are interested in getting paid. If they see delays in payment, if they see poor financial statements, they may make decisions, i.e. not to supply. Customers, what do customers want? Well, broadly speaking, they want quality, they want value for money. They may well depend upon the entity. So, they may well have some sort of long-term relationship. So their needs are going to be geared to what the entity produces, whether that's a good or a service. Government entities and indeed their agencies, again, we're talking about compliance here. We want to make sure that businesses comply with current tax legislation. In other words, that they pay on time and that they file on time. Okay? So this concludes our first chapter, a fairly long one for us. Some of the chapters are a little bit shorter, but this was an important chapter because it sort of sets the scene and gives us a sort of a bit of a grounding on quite a few different areas, not least types of businesses, types of financial statement, and indeed, individuals or stakeholders who are interested in those financial statements. I hope that you found the run-through helpful and indeed that you've made your notes. Remember, as mentioned, that in terms of getting through the various chapters and indeed videos in the course, the key thing for us to do is to focus on getting through the material, i.e. the reading of the chapter and the video as quickly as we can, and then getting into learning from the question practice. That's the key. I think it's so important that you make question practice a high proportion of your time. Okay, so please do join me for chapter 2 shortly. I hope that your studies are going well so far, and thank you for listening to me.